Hey everyone, so welcome to the workshop. We're going to talk about how to use life insurance as a tool to build wealth, right? Whether or not you're here for the protection aspect of life insurance, you're here for the generational wealth aspect for life insurance, whether you're here, hey, how do I combine life insurance with crypto? How do I combine life insurance with real estate? How can I combine it with the stock market? We can kind of discuss those strategies somewhere in the end, but the idea for this training is I really want to go over concepts. So the way I'm going to structure it is in the beginning we're going to talk about concepts. Then we're going to talk about why is life insurance the most so it's a superior tool to hold your class. It's in a class of its own. There's nothing like it, right? And then in the end we're going to run some math. We're going to run the numbers and we're going to look at what it looks like if you were to implement it in your wealth building process, right? Like how can it help you with that aspect? So before I get started, it's a little bit background. I got started in real estate. This is really how I found this space. I was doing flips, I was doing wholesale, a lot of wholesaling, right? So I was knocking on pre-foreclosure doors, 30 doors a day for almost 2 years. This is really how I learned the creative financing part of real estate. This is how I learned how to communicate with the bank to negotiate the deals, right, for the people that are about to lose their house. And so that's how I got into the space. Now, I had two massive wholesale deals where one was in the six figures, the other one was right below it. And I was like, what am I going to do with this money? Okay, so that's how I found this space. I read a book called Becoming Your Own Banker. Maybe I'll put that somewhere here. Um, Healing Sacred Cow by Garrett Gunderson. I actually flew to Utah to meet that guy, and then I also read a book called Busting the Life Insurance Myth. So after these three books, I started my first policy, and then now I'm with my third one. Right, my mentor, who was trained by Nelson Nash, who is the author of Becoming Your Own Banker, he's the one that really taught me this process, right? How this process worked, how to look at it. Now, he's always taught me since the beginning that this is not an investment, this is a strategy. And that's a big misconception, especially when you're hearing a lot of people out there selling this as an investment. It's not, it's a strategy. What you do with the money inside, that's the investment aspect of this. Okay. So let's get started because I want to keep this around 30 minutes. I'm going to talk fast. Feel free to watch this or slow it down or, pause it, replay, right? When you can. So let me move this. So the way I'll start usually with this is whenever it comes to wealth building, I simplify it, right? The wealth is going to be built between the gap of between your income and your expenses. The larger the gap, so that's it. This is your this red line is your expenses, and this is your income. The larger that gap, the faster you're going to generate wealth because you can use that extra money that you have to put into the market where it can multiply for you, right? Now, that being said, everybody has different incomes. Okay, everybody also has different scenarios, different situations in their life. So this is not for everyone. If you're not saving money, you can turn this off. This is not for you. Or maybe learn the concept that I'm going to teach today because that's really going to help you. But as far as you implementing this process, if you're not saving money right now, it won't work. You need to have liquidity. You need to be putting money to the side already in order to implement this. Okay, minimum 6,000 a year. And then you can just go up from that 6,000, 100,000 a year. They won't put to the side 50, 25, 100. We have people right now that are looking at $1 million policy to use for their businesses, right? So the larger the gap, the faster you're going to generate wealth. Now, we all have a different circle of wealth, right? Some of us have smaller circle of wealth. Some people have bigger circle of wealth. But what do we have in common? Everybody wants that wealth to grow. Okay, so before I get into more concepts, I want to talk to you about this first concept right now, which is the three types of money. Okay, you have accumulated money, right? Accumulated money is money that this would be your real estate that you're putting to the side. This is your crypto. This is your stock market. This is where most financial advisor will focus on, right? Let's accumulate, accumulate, accumulate. Put that to the side. Let that grow. Okay. The other one is lifestyle money. This is where usually Dave Ramsey will focus on, right? Cut your lifestyle. Do this, do that. Sell your kids. Like cut everything, and everything else will move to to accumulated money. Where a lot of people don't focus on is transferred money. And transferred money is money that you're giving away unknowingly and unnecessarily, meaning in a form of, let's say, interest and credit card. How are you paying for your house? How are you paying for your car, right? How are you paying for your taxes? What if you're paying 50K in taxes? What are you paying 100K? We have a client right now that's paying 100,000 in taxes. If we can cut that down to 30, that's a $70,000 savings, right? That they can put in accumulated money or they can add to their lifestyle. Okay. So I tend to focus more here first before looking at these other areas. So just keep that in a box right now because we're going to review this in a little bit. So when it comes to wealth transfers, like I mentioned, money that you're giving away unknowingly and unnecessarily, there's this thing called opportunity cost that most people are not, they either don't understand it or they're not seeing it. So what is opportunity cost? Opportunity cost, when you have a dollar and then you have two choices, right? You're either going to spend that dollar or you're going to invest that dollar. If you invest that dollar over time, that money is going to grow. If you spend that dollar, whether or not it's injected into your lifestyle, right? That's most likely where it's going to go. That money is gone forever. So opportunity cost is what that dollar could have earned for you if it went into that investment tank, right? So that's opportunity cost. Now, if you're looking at it, let me see here. If you're looking at those transferred monies, these are some of the areas that will have majority of those money that are being transferred unknowingly and unnecessarily, right? Like mortgage, how are you paying for their mortgage? Taxes, qualified plans, right? Like you have a business partner in those, right? You have Uncle Sam. You're not getting taxed on the seed, but you're not getting taxed on the seed, but you're getting taxed on the harvest, right? It's a postponement plan. So how can we capture some of those taxes? Protection, how are you paying for your protection? Whether it's life insurance, auto insurance, or whatever type of insurance that you have, right? Kids education, major capital purchases, you're buying a car, credit cards, how are you paying for that? So let's look at this really quick as well. Like car is the most common thing, so I just revert to this. So when you're looking at your circle of wealth, you have your wealth, you have, let's say, the car interest, right? The debt principal that you borrowed from the financial institution, and then you have the interest, and then, like I said, where most people don't see is the opportunity cost and not money. So when you're looking at it, let's say, let's just keep this because this is where most cars are nowadays are costing anyways. So let's say you have a car, you're financing it at 6% for 5 years. What does that look like? That means you paid $9,000 in interest. If that 9,000, right, would be put somewhere where it's earning, let's say 6%, what does that look like? This is what it looks like. In 5 years, that 9,000 could have earned you, is now compounding, right? Now it's worth 12,000. Okay. In 10 years, it's worth 30, 20, right? So 80,000. So that's opportunity cost. Imagine if there's a different way to purchase that car, let's say that $60,000 car, instead of you putting it somewhere where, you're borrowing for that financial institution. What if there's a way to arbitrage that car, right? That 60 would have turned to 80,000 in 5 years, in 10 years, in 20 years, right? Imagine like you buying a car for yourself, for your wife, for your kids. I mean, 5 cars, right? 6 cars in a matter of 20 years, even more. You know, how many times do you transfer cars? Every 10 years, you get a new vehicle. That's a lot of money that you're giving away. Okay. So this is just, we're basing this on one number, right? On 6% in 20 years. So that's opportunity cost. That's what most people don't see. Now, when you're growing your money, let's say you're growing your wealth, what a lot of times happen is you're also growing everything else that comes with it. Okay. So ideally, the goal is to grow your wealth and keep these other areas here the same or lower, right? That way you're it's kind of like you pouring money on a bucket that has holes in it. If those holes, there's a lot of holes in your financial bucket, you can, what else can you do? You're gonna make more money, pour more money into the bucket, right? But those holes are just like leaking. So the best way to do it is to plug those holes so that it doesn't matter if you put a lot more or just put a little bit, that money is always going to continually grow, right? So that's the idea. How can we do this? How can we accomplish this? Okay. Now, going back to this, accumulated money, like I said, this is money that you're accumulating. This is where most financial advisors focus on. Lifestyle money is where, like I said, Dave Ramsey usually focus on. Save your money or cut your lifestyle in order to inject more money into here, right? Cut your lifestyle. Where I like to focus on is the transferred money, because if I focus on this, let's say I save X amount of money that you're losing unknowingly and unnecessarily, then we can add that into these areas, right? I don't need to change your lifestyle in order to um, to generate more wealth. We're keeping the same exact lifestyle. We're just finding those leaks, right? How can we find those leaks and reallocate it into a better environment for your money? Okay. Transferred money, and it goes back to this. Here's just a sample right here. Let's say somebody that's making $150,000 a year, like let's say they're saving 10% at 6% savings. 6%, 10% savings, and that savings is earning, let's say, 6% a year. Look at that, $900 a year, right? That he's making on that $15,000 savings. Now, let's say I found 1% of that 135, right? Let's say we looked at your finances and we just found 1% of it. What does that look like? That's equivalent to 9% return on your money, on your savings, just by finding that, right? If you look at the math, 9% of 15,000 is 1,350. What if I found 2%? That's an equivalent of 18%. So for me, if you're looking at rate of return, sometimes, right, depending, again, everybody's different, is most of the time, it's always better to look at those leaks first. Where are you leaking before we go into offense, right? It's always good to look at the foundation before you start going into offense on your investments. Now, you can always do that, but if your foundation is weak, then it's harder to build wealth when your foundation is weak. So I hope this made sense. Now, this one right here is, we call this your personal economic model. I'm gonna go over this really quick because I want to be able to reference like savings tank, investment tank, lifestyle, income, capital, right? There's gonna be some stuff that I'm gonna refer to, and I'm gonna review this, right? Going back to this concept. Now, this looks like kind of like a water plumbing system, right? Because water and money have a very, very similar flow. Water, if it sits somewhere, let's say inflation, right? A couple of years ago, inflation was at 9%. If it sits with 9% inflation, or water just sits somewhere and not do anything, water goes bad. Same thing with money. Money needs to move constantly. So what does this look like? Why is this built this way? Why is this tank bigger than this tank? So let's close this for a second. You have your savings tank, investment tank, and lifetime capital potential. These two are smaller than this because this is the lifetime capital potential is this every dollar that you're going to earn in your entire life, right? This is every dollar that's going to flow into your life. So the way money flows is like this. The money goes in. Before that money goes into your lifestyle, your business partner takes a cut. Who's your business partner? The federal government, right? That's your business partner. They're going to take a cut. And where most people make the mistake is before it goes into their lifestyle, this is your lifestyle regulator, most people are living 100, 105%, 110% of what they're taking in. Goes back to the income gap that I'm talking about. There's no gap. It's like negative, right? It's negative. So if we don't adjust this needs to be adjusted. Let's just say 80% to 90%, so that when the time comes, when this goes into your lifestyle, right? You adjust this to 80% so that you can pump more money into the savings and the investments, right? Because once that money goes out, house, car, kids, education, right? Protection, cell phone, entertainment, whatever, clothing, dinner out or whatever, right? Like eating out or food, that money is gone forever. You're never gonna see that money again. Okay, you're never gonna see that money again. So the nature of the savings and investments is this: investments, it goes up, it goes down, right? That's your investment. It goes up, goes down. Hopefully, it keeps on going up. 2020 happens, it goes down 40%, and eventually now we're higher, right? So the nature of investment, there's risk involved. The red part here is the taxes. The government controls that. They control two things: the taxes and the tax calculation. Okay, they can say taxes is 30%, 20%, right? They can even say as low as 15%, right? But they also control the tax calculation, meaning they can say, hey, rich is now 150. If you make $150,000 a year, we're going to tax you 40%. We don't control this piece, right? The government controls this, okay? So that's the nature of investments. It goes up, it goes down. Savings, completely different. It's safe, right? Goes up, goes up, goes up. You'll notice here that there's no cap, meaning the investments keep on going up, and then the saving here, right? You have your savings. Most people have like a comfortable savings. Like sometimes they'll say, okay, I gotta have 50K sitting over here, or 3 month supply, or 6 months, or 12 months for me to feel comfortable, right? But the general idea, to be in position A, you need to have money in these two tanks, because one day this is gonna stop, meaning your income is gonna stop. You're just gonna be able to rely on these two tanks. Okay. You have to open these tanks and release money out into your lifestyle, adjust it for inflation. You want to live the same or better lifestyle, right? In the later years. This is why I don't agree when, financial advisor will say, oh, you're going to be living less. You're going to be living, you're not going to need that much money. It's going to be less. Well, when you retire, when I talk to a lot of retirees, guess what every day is? Every day is a weekend, right? Every day is literally a weekend. So if you don't have money in these two tanks, how are you gonna, you go out, you go enjoy your kids, you go enjoy your grandkids, you can travel, do all the things that you've done that you want to do because you've worked your entire life. So you look at this way, right? This is your paycheck and this is your playcheck. Meaning if the investments are good, this is when you do all your extracurricular activities, enjoy your kids. But this covers your month to month, meaning you can sleep good at night knowing that next month is covered, next month is covered, next month is covered, next year is covered for the rest of your life. That's your paycheck. This is your paycheck. Okay. So that's position A. All right. And we'll review this again later on. I'm gonna go over some of these concepts here, but that's the general idea. Okay, with your personal economic model. So you finance everything you buy. There's another concept. You finance everything you buy. You're either gonna pay interest to somebody else, right? Some people say, no, Joe, I don't pay interest. I pay cash. Well, if you use that cash, you're giving up your ability to earn money on that cash now. Let's say you pay cash for a car. Now that $60,000 that you paid in cash, that cash is gone forever. The company took that money and reinvested it, right? So you're either paying interest or you're giving up the ability to earn interest on your money. Every dollar that you're not saving, you're either consuming it, right? It's either getting transferred or it's going into your lifestyle. Okay. And then this one right here, I like this because when I first saw this, it was very, very clear to me, right? Like it just made sense. So hopefully this can be the same thing. This could be, this can kind of give you an idea, like the way it kind of, opened another door in my mind, right? So there's three ways people spend money, right? There's your spender, So think of this line right here as a zero line, right? Your debtor or your spender is they get in debt, they spend money, they get back to zero debt. The problem with this is, let's say they're sitting over here, they get in debt, and then they get in debt again. That debt can spiral out of control, right? Your credit card debts. So that's your debtor, always trying to get back to that zero line. The next one is your saver. Save money, pay cash. Save money, pay cash. Save money, pay cash. Nothing wrong with that, right? Some of my best clients are savers, right? They're saving a lot of money, but every time they pay for something, is they pay cash. So they're always trying to get back to that zero line. They don't get comfortable until their savings is back to where it was before, right? Like I said, 3 months reserve, 6 months reserve, 12 months reserve. Some people have a number like, oh, I got to be 100,000 sitting in my checking account, 500,000 sitting in my, everybody's different, right? Different circle of wealth, right? So, but they're constantly paying cash for something. Now, the third one that we're going to talk about is the wealth creator. And this is really what we're going to emphasize. How can we do this? How can we arbitrage our money? Is they put their money somewhere in a better environment where the money can thrive. And if they need the money, they're going to borrow it at the same or at a lower rate. Okay. They're going to borrow it at the same, they're not draining the tank at the same or at a lower rate. So you'll notice by that time they pay that money back, their tank is already sitting higher than where it was. And as you inject time and compound interest into the process, you'll notice that the gap gets bigger. Okay. And we'll go over this more, but that's the wealth creator, right? We're putting our money in a position to where it can thrive. We're not draining the tank. We're going to use OPM, other people's money, when we need it, for major capital purchase, for investments, for real estate, for crypto, for the real estate, right? For a stock market, that's what I meant to say. So this is what it looks like. Spender spends money. Uncle Sam takes a piece. He goes into their lifestyle. Gone, right? And if they need credit card, they might go to the credit card companies. Borrow money, pay it back, borrow money, future income obligation, right? Credit card company, or in real estate, it would be hard money lender, hard money lender, hard money lender, right? As they're growing their wealth. Okay, so that's a spender. The saver, you're putting money, they're constantly saving. This is MCP is your major capital purchase fund. So this black line is probably, let's say that's 500,000 and that's where they feel comfortable, 100,000, that's where they feel comfortable. They're always going to do that. But when they need the money, they pay cash. They pay cash. They pay cash, constantly draining that tank, right? So their investments are growing, right? They might have some savings a little bit, but their major capital purchase funds is always getting drained when there's something comes up, either an investment or a wedding or college, whatever, right? This is how it's usually done. Okay. And then the other one is your wealth creator. So instead of us draining the tank, what we need to do is we're going to collateralize it. So that money investments is here, is doing its thing. Savings is growing. But when you need the money, instead of you draining this tank, you are now collateralizing it. So that tank can keep on growing, right? You need the money, major capital purchase, collateralize, OPM, right? OPM, okay? So this can grow and grow and grow and grow, right? So that's the idea. This is really how the life insurance works, right? This is where we'll talk about the benefits here in a little bit, but that's the 35,000 feet view of the process. Now, here's another one. If you understand this, then you will understand the power of what I'm about to teach you. If you don't understand it, like I said, keep an open mind, maybe explore it more. But if you get it, you'll be like, oh, wow, I get it now. Okay. So let's say somebody is, let's just look at 300,000. Okay. Let's look at 20 years, maybe 20-year period. That way there's more lines. You can go 5, 20, doesn't matter. If you put that money earning 5%, right, compounding, you're going to end up with around $800,000, right, in 20 years. But your money grew to 800, so you made around 513,000. A loan for the same 5%, look at the difference. Over here on the loan, you paid 175,000. Over here, you made $500,000. Imagine that. Imagine if that was like 7%. That's like, over here you made $1 million. Over here, $250,000. You just gave up $750,000, roughly 650, right? Because either you're paying cash for something, or your dollar is gone, right? The money's gone forever. Yeah. So like I said, if you understand this, then you'll understand the interest arbitrage play, the collateralization play that we're about to discuss here in a little bit. So true cost of paying cash. There's another one that I like to see because it's very visual. Let's say somebody is saving 20,000 a year. Let's say that money is earning 6%, 30 years. Let's say you drain the tank, going back to like draining the tank, right? You drain it 5 times and it took you 3 years to refill it. So let's say you're refilling your tank, you drain it again. You're refilling your tank 3 years, you drain it again. 1, 2, 3, drain it again. 1, 2, 3. So you did this for 5 years, right? You did this every 5 years. Around year 15, you're like, man, I can't keep on draining my tank to use, for all of these major capital purchases that I'm doing. So you keep it. Now you're not draining it anymore for the next 15 years. But because you drained it 5 times, it cost you 1.1, almost $1.2 million. Okay. Opportunity cost. You're resetting the compound interest curve on your money. Most people don't see this, right? So because you reset the compound cycle of your money, that's how much you lost. Your dollar today is not the same as the dollar, year from now, even a day from now, right? So I want to talk about this inflation and how your dollar gets affected with inflation, because a lot of times, whether you're paying cash for your house, or you're paying cash for something, or you're putting your money into a savings account that's earning less than 1%, or earning 1%, or earning 2%, right? Let's say you tell me, Joe, I want to retire. My desired income is $100,000 for easy math. Okay, let's say the inflation is, inflation rate. So the inflation rate for the past forever, right? Changes. Look at that. Sometimes it's like 8%, sometimes 2%. But let's just say average. 1990 it was at 5%. I think it was a couple of years ago. 2022, look at that, 8%. Right now we're hovering around 3. Okay, sometimes it's 1, but average I think it's 3%, right? What does that look like? Okay, year 1, year 2, year 3. Look at that. The value of that $100,000 is depleted. In 15 years, you're looking at 60. You're looking at 64,000. In 20 years, let's say you're retiring in 20 years, that 100,000 is now worth that much. So how much do you need? For 100,000, you're going to need, let's say it's moving every year. In 15 years, you're going to need 155,000 in order to live the same lifestyle. In 20 years, you're going to need 180,000 in order to the same lifestyle as 100,000. I remember my parents used to give us, my mom used to give my dad $20 a week for groceries, right? This was years ago, like maybe like in the mid 90s, you know. That used to like buy food for the whole family. Now that $20 can maybe get, I don't know, 3 to 4 items in the grocery store, right? So your dollar today. Now going back to some people that will say, let's look at this from the mortgage perspective, because I have clients that are putting an extra $1,000, an extra $2,000 a month, right, in their mortgage. Let's say you're paying $3,000 a month in mortgage, right? Let's calculate that. And I want you to think about this, because the first time I've ever heard this, somebody said to me, don't ever pay off your mortgage. I almost walked out of the room. Okay. Now, that being said, I'm not saying don't pay off your mortgage, but I will explain it in a way that, what if there's a better way to where you can pay it in full whenever you want to? It's just literally sitting there like equity in your home, can be paid in full when needed, right? That's really what I'm saying. But the reason why that guy said that is, think about it this way, okay? Equity and appreciation are completely different. Equity earns 0%, meaning if you're putting $100,000 inside your home, that money is not going to earn anything. It earns zero. The house is going to do what it's going to do, meaning the house is going to go up in value. It could crash. The market could crash. It could go higher. Like I said, it's going to appreciate anyways. So why trap your money inside your home when you can put it in an environment where it can earn X amount, and when you need to put that money in full, you have full access to it whenever you want, right? So, and then there's tons of other benefits that comes with that, but we're going to discuss it after this. But I want you to think about it this way, okay? 3,000, let's say in 5 years, look, that 3,000 is worth in 15 years, that 3,000 is only worth 1,900. So my next question would be is, does the bank want this, or did they want this? Okay, I'm going to repeat that. Does a bank like it when you pay the loan sooner, or when you pay it, when you extend it? Obviously, they want you to pay it sooner, because the sooner they get that money, they get that dollar, that's as valuable as that dollar is going to get. That dollar is never going to get any valuable than what it is today. Tomorrow, that dollar is going to be worth less. So they want to get that money as soon as possible so they can move it into other asset classes and buy more stuff with it. They're not going to be able to buy assets. They can still buy it, but they won't be able to buy it at that rate. It's going to be less. It's worth less, right? So they want this money because, look, in 20 years, 25 years, it's only worth 1,400. It's like half the value. So yeah, they want that money. They want that money now. That's why whenever you look at your amortization calculator, everything is an interest in the first 10 years, right? And then the principal is later on, because they want that money as soon as possible. That's why it's designed that way. Okay. So when you're looking at it let's kind of revert back to the life insurance, right? When you're looking at a place to store your money, let's say a private reserve account, what is the best environment for your dollar? What does that look like? So we looked at all the different accounts out there, meaning every single benefit that's available today in the market. Okay, and this is what we came up with. Okay, tax deferred growth. Okay, this is where you postpone the taxes, right? That's a benefit for a lot of the financial products out there. Okay. Tax deferred growth, that's pretty common, right? Tax free distribution, you want your distribution to be tax free. You want competitive returns, obviously, because it has to, at a minimum, beat inflation, right? You want to be able to be better than inflation. So it has to have a competitive return when you're storing your money as a private reserve account. I'm not talking about investment. Investment is completely different, right? I'm talking about your safe tank. You have your paycheck and your playcheck, right? Going back to the personal economic model. I'm talking about just a storage of cash. How do you store your money where the environment is better, where your money can thrive? This is what we're talking about. We're talking about a private reserve account. So what are the benefits? What are the best benefits out there? Competitive returns, high contribution. You're able to contribute as much as you want. Deductible contribution, collateral opportunities. You want to be able to collateralize it, right? If you need it, right? you want them to have access to that money. It has to be safe. Super important. If it's not safe, I don't want to put my money in a place where I'm going to lose it, right? No loss provision. All that means if your money is at 100,000, it grows to 105, and then that 105 goes into 110. That's your new floor. It goes into 115. That's your new floor. It goes into 130. That's your new floor. It will never go below your floor, meaning you'll never lose money, right? No loss provision. Safe, like I said, some of these companies have been around for 150 years. That's a good when it comes to the life insurance product. Guaranteed loan option. When you need the money, you want to have access to it. Okay. What happens if you have equity sitting in your home today? If I were to go get a HELOC loan, what usually happens? The bank is going to go up to me and say, Joe, what are you going to use this money for? Give me your tax return. Give me your W-2. What are you going to use this money for? Give me this, give me this, give me that. There's a lot of requirements, and then that might take 45 days, right, for that money to get transferred in your account. So maybe by that time, the opportunity is gone, depending on how fast you need the money, right? This, if it was sitting inside your house, okay, meaning HELOC equity, right? Guaranteed loan option, all that means is like when you need the money, you get it right away. Our process, about 3 days. I go online, I type in what I need, it's transferred to my account in 3 business days, sometimes less, but I would say 3 business days on average, right? Unstructured loan payment, this is very, very important because when I use this process, the payment is unstructured, meaning I decide how much I want to pay on the loan. Normally, if you were to go borrow money from the financial institution, either to buy a home or to go with a hard money lender or to buy a car, you're kind of like under the gun in a way because there's a required monthly payment that you need to pay. Sometimes, depending on, like, for example, like if last flip I did $80,000 flip, I used my policy cash value and I just told them $50 a month until my project is done. They didn't even ask what I was using it for. It just got transferred, but I just told them $50 a month. You make that decision in how much you want to pay instead of them making that decision for you. So you have more control on your cash flow when it comes to like investments, right? Because sometimes the investment might not come back for like another 12 months, right? So you have that flexibility. Unstructured loan payments, $0, $50, $100, completely up to you. Or you can amortize it, right? Pay $1,000 a month, completely up to you. Liquidity, use, and control. Always, you want to have liquidity, use, and control of your money always, right? And then additional benefits. This is really where we get deeper into why the life insurance product is superior, right? Because not just you have access to the money that you put in, you have a massive death benefit, you have asset protection, you have long-term care. There's so much more benefit that comes with it. Everything completely underneath the IRS's grid, meaning everything you do in that policy, it doesn't show in your credit report, nothing, right? Completely off the grid from the IRS, doesn't show up anywhere. It's a private contract between you and the life insurance company that we decide, whoever we decide to use, And let's just kind of, for this, I want you to pause this because I'm already over 30 minutes, guys. So I'm going to go faster here. 401k, right? There's only 4. CD, there's only 4, right? So pause to this, read through the stock market, right? Margin call, okay? I've had that happen to me before. It's horrible. 2, 4, okay? Real estate HELOC, only 2 on the HELOC. What else? Savings account. Wells Fargo, Chase, only 4. So if you're just looking at savings account compared to this, it's everything except for deductible contributions. Okay. So how it works, the way it works is very simple, right? Let's pretend that this is the money. This is where you inject your money, right? Once you put your money into your policy, that money is now going to be in an environment where that money can grow uninterruptedly, meaning it can just keep on growing without it being interrupted. So this is your cash value, right? Now, and obviously you have the death benefit attached to it, etc. Now, in a nutshell, the way it works is when you need the money, let's say you have 100,000 in here. When you need it, let's just put that here again for easy math. Let's say you have 100K sitting in here and you need 50,000. You just go to the life insurance company and say, hey, I need 50K for investment, right? They will just put a lien on your 100K. They're not draining the tank, okay? They'll send you that 50K. You can use that to buy other growing assets, right? You can use that to buy crypto, real estate, enter the market when it's at a discount. And it goes back to this strategy where, like, my mentor on this, he just enters the market every I don't know, 4 to 5 years. 2020, he turned 300,000 into 1.2 million by buying a bunch of oil and gas companies like Shell, Chevron, all the oil and gas, right? Because at that time it was completely like the stock market just crashed. So he looked at all the best deals, took 300,000 from his policy, injected, made 1.2 in 12 months, took the foundation out, which is his 300,000, put it back into his policy, right? Once you put that back, oh, sorry, let me go back. Once you put that back, then the money is gone, right? Take the lien out. And then the other $900,000 profit that can grow outside the policy. Okay. So that really is a process in a nutshell. Super easy. Don't overcomplicate it. You're really, this is kind of like, you turn into like, you have like two brains, right? You have your banker brain and then you have you, okay? So whenever I teach this, I always say, hey, when you're using that money, when you're making the decision whether or not to use this money, you have to tell yourself, is this lien, right? Is this money going to make me more money? If the answer is yes, then yeah, go ahead and borrow it and then pay it back. If the answer is no, then don't use it, right? So that's to simplify it right there. So now let's look at a case study, right? Just a kind of like generally speaking, this is somebody that's saving $50,000 a year. The percentage are going to be very similar, and every company is going to be different. There's infinite design when it comes to this, right? Whether you want more death benefit, you want more cash value, how to structure it, tons of different designs. So it just really depends on the needs of that individual. But what I want you to understand is when you're looking at this, somebody that's saving, real estate investor is saving 50K a year. Normally, like he'll have like $1 million sitting in his account, right? And he would say, okay, I have a deal here. I'm going to pay cash for it, right? That's where this person's at. Like pay cash for it, do the renovation, fix it, put it back in the market. Maybe take 6 months, 12 months, and then replenish, right? Replenish it, or maybe he'll only use $500,000 of that 1 million, right? But the idea, and whenever I look at this, I look at this from the lens of sure things and maybes, okay? When it comes to life, there are sure things, which is going back to the tank. This is your sure thing. This is the safe tank. And then you have your maybes, which are your investment tanks, okay? Also, and I'm just going to get a little bit ahead here because I'm going to come back to this. You also have your gaps and then your cliffs, okay? So what do I mean by that? Okay, sure thing, maybe, gaps, and cliffs. Gap in your life is like, hey Joe, I need, I'm spending, let's just say I need $5,000 a month and I'm only making 4,500, right? So that's a gap of $500. So we got to figure out how to cut that, especially if you're only making 4,500 and you're spending 5,000. Or you might say, hey, my budget is $2,000 a month. This is my lifestyle budget, but right now it looks like I need $2,200 a month, right? That's a gap of 200. So you have to figure out how to make another extra 200. A cliff is like, everything is great. I'm making 5,000 and I'm only spending 4, or I'm only spending 3, but boom, somebody dies in the family. Cancer hits, right? Accident, right? Things that you're not seeing, those are cliffs, okay? So in our life, there's always those cliffs. So this is why when I talk about foundation, if your foundation is built on quicksand, you can build this wall tower, right? Foundation is weak. Something happens in your life, boom, that whole thing can crumble. So all of this time that you're spending building something, if your foundation is weak and you're not protected, that wall tower can just crumble. So this is why I always focus on a strong foundation. So when your foundation is strong, your sure thing is strong, then we can focus on offense. Then we can take more risk, right? This is why you focus on cash flow, because when you're focused on cash flow, it will alleviate a lot of those financial pressure, financial gravity that's happening in your paycheck every single month. So if your paycheck is coming in at 5,000, and then you're creating slowly here, like every year you're creating an extra 500 in cash flow. Eventually, by year 6 or year 7 or year 8, the cash flow is going to be enough to alleviate a lot of these financial pressure that's coming in on your income, right? That's what they call, that's the definition of the FU money, to where now you can take more risk because your month to month is already covered, right? So going back to this, sure things and maybe. So when I talk about investment is a maybe. So I'm just going to keep that at 0. It's going to do what it's going to do anyways, whatever risk you're taking, right? So, I mean, that could be growing at 5%, 10%, or that could be negative 20%. It doesn't matter. But I don't want to deal with that maybe. So, but the sure thing is there's a savings here of 50,000 a year, and it's sitting in an account, probably earning less than 1%. Okay. And then every time he pulls it out, he puts it in investment. Obviously, that's going to grow. And then he puts it back here, right? So let's look at the constant savings here. And all we did is, and then the cash flow, obviously there's no cash flow in that, because the cash flow that's going to be coming from his investments, right? But the sure thing cash flow, I don't have any sure thing cash flows, right? There's a cash flow that's coming from the investment. Again, I'm going to separate that. So no, 0 protection, no life insurance, nothing. 4 kids, wife, both make really well money, but no protection. So the solution that we came up with, let me see here. It's this. Instead of him putting it in that account, we'll just put it into a policy that's structured with high cash value, because he still wants a liquidity. And this is what we created for him. Year 1, you can see that he already has access to almost everything, right? I think it's somewhere in year 5 where he has access to every single dollar that he put in. But what you'll notice here, we just created a cash flow engine that's putting this up every year and is growing every year. You'll notice over here that at 800,000, like let's see here, what happens usually here is, like, let's say he uses this 400,000, right? If he uses 400,000, that goes to 0. Now the 400 comes over here. Let's say the 400 turns into 600, right? Then he would put that 400 back here. Let me see here. And then there would be like 200 left here, right? And then that can grow and it can do whatever it needs to do. That's the same process here, except we're just adding, just keep that 0. We're adding these 2 columns here, right? Now you have the protection aspect that's coming in, and then you also have the cash flow that's coming in. So really, again, the math is going to be very similar. If you're looking at an illustration here, this is really what kind of looks, how it looks like. Like the only difference between these 2 columns are this one has a dividend, right, that's coming in. compared to this side right here. But you can also see that the death benefit starts off at 700,000, and by the time this person is 64 years old, you already have a $3 million death benefit. By that time, he's put 1.2 million into the policy. He almost had 2 million sitting in his policy as far as access to capital. And then, you have the 3.5 death benefit. So the death benefit is growing, right? The policy is designed the complete opposite way, meaning we're buying the least amount of death benefit that's allowed, right, by the IRS for us to design this underneath the modified endowment contract line, which is completely off the grid from the IRS, tax-free, all the benefits, right, that comes with life insurance. We're buying the least amount of death benefit and injecting the rest into the cash value, which, as the year goes back, we're actually the cash value is chasing the death benefit. This is also the reason why it's a loan that you never have to pay off. Because if you're putting your minimum contribution, which is in this case, to keep this policy going at 50,000, you're probably looking at, $7,000 that you have to put in every year to keep the policy going. The rest is getting injected into the cash value, right? So your minimum requirement is 7K and is 50K design, and your death benefit is growing. Your cash value is chasing your death benefit, and that should equal at 121 years old. It will equal, So that's how the policy is designed. This is all I got, guys. I'm already, I think, almost an hour here. So if you have any questions, reach out to me. I hope this made sense. I hope the concepts made sense. And then we can kind of talk about your scenario, because like I said, everybody is different. You have different goals. You have different circle of wealth. So it really just depends on what you're trying to accomplish. And maybe we can create a strategy whether or not you want to use this for real estate, use this for the stock market, use this for crypto, tons of different stuff that you can use this for, or just use it as a private reserve account for like an emergency fund, right? That's just there for you to use when you need it. Okay. I hope that made sense. And then reach out to me. I can send you my calendar link as well, but feel free to reach out. Let's book a call. Let's talk and kind of explore this further, right? Take care, guys. Have a good day.